So good late morning, good early afternoon, late morning that is, to Professor Charles McFerren. We're here today to explore the same topic we've been looking at with other professors in the recent past, that is COVID-19, the situation today and how it relates to what these professors teach and do and think about. And today with Professor McFerren, who teaches economics, and who's very familiar with the oil industry. We're going to be looking at the oil industry and oil today, but more largely what the earliest economic indicators might be telling us about what's to come in this unprecedented COVID-19 situation. So, Professor McFerren, it's wonderful to have you with us this morning. And the topic on everybody's mind is we don't have anywhere to go, so here we are all thinking about COVID-19 in our apartments and homes. And you proposed to discuss COVID-19 in relationship to oil prices and other economic indicators. Why?
First of all, just let me say thank you to McDaniel for putting these together, for starting these discussions, these interviews. I found it's useful because through watching them, I know the McDaniel faculty now much better than ever. I never really got to meet people too closely when we have the faculty meetings, and this way it is a platform to exchange ideas anyway. And the starting point for me was when I was watching the interview with Dr. Antal of the macroeconomic situation and leading to predictions, of course, of how things will settle down in the end when the dust settles. It said, oh, I think that would be interesting to maybe follow up on with a, I don't know, not more applied, just a more detail about one important market. Mm-hmm. And one important market is the oil market, the largest commodity in the world, the basis for much of the economies. And I have some experience in that because I worked for the Abu Dhabi National Oil Company for 12 years. So I have an idea how the oil market works and also how the decision makers think. So that was the starting point. I thought, oh, okay, I can add a little bit to the conversation.
In fact, indeed, and more than just a little bit. So without further ado, I know that you've brought some visuals with you, and we'd love to see those visuals and for you to walk us through them. And as you do, I'd like to start with a kind of question that I guess these visuals and the indices you're showing in them responds to, which is financial markets of various sorts, of course, are receiving different kinds of information and responding to that information. Can you expand on what that means and in particular what we're seeing in each of these visuals that you're going to show us?
I'll just refer back to my notes a little bit with from Dr. Antos, because there were two things that he said at the analysis that I think is very relevant. One, he said this is both supply side and demand side. Mm-hmm. On the supply side, there's been a shock. The oil prices, which is part of the source of my little discussion, and on the other side is the demand side. Because of all of the chain of effects for what happens when people get afraid and stop to buy, what happens when governments have to take actions to limit the amount of social interaction. Mm-hmm. So there's both of these effects going on at the same time. And all of that has effects in money making, if I put it like that. One of the advantages of financial markets or of markets in general is communicating in a price, in the price structure, what the market, the market is thinking about what's going to happen. And so I thought, oh, that would be kind of a good basis for the discussion. Instead of just speaking broadly, let's look at what the market is saying. That's sort of the beginning point. But then the second sort of sub-point is that the market is not always right, right? There can be information contained in the market that is because of, I don't know, herd thinking, because of regulations, unintended consequences, and some of that we're seeing now, also. So I think that in putting together my slides a little bit, I was looking at what does the market say about, or how can we interpret what we're seeing in the market, but also some comments on the side of this could be wrong. Again, that's why it's easier to comment rather than to actually be the investor side, because if you're on the investor side, you have to bet real money. Yeah. To talk about it is much easier.
Right, right. Well, if you're betting someone else's money, maybe it's not so bad, but of course, that's understood. So let's have a look if we could.
Okay. As I mentioned when we did the dry run on the weekend before the internet went bad, I apologize a little bit for putting together slides because it looks more formal than what the discussions are meant to be, I think. But I feel more comfortable in showing pictures rather than just talking with my hands and sort of indicating directions. So I apologize for the formality. This is not supposed to be a lecture, but it gives me a chance to point to pictures that you see with a little bit of internet search. So that's the reason. And I thought that it would be better also to structure a little bit of what I had planned to talk about. Again, and this is the last time I'll thank Dr. Antal, but based on the structure that he had for his discussion, I took the same thing and then I just drilled down a little bit into a few key areas. So my structure is, what did the markets already indicate before COVID? COVID is the trigger. What is the effect of COVID on oil prices, US dollar, stock prices? Three areas that I have spoken with a lot of people about over the last weeks, just for analysis purposes. And then it comes down to, in the end, what's going to happen with prediction for the what will happen in the middle of this year, at the end of this year. And that's a little bit of not a little bit, it depends on consumer confidence. So I had one slide to show what the market is showing about consumer confidence right now. So if I would just start, and please interrupt me or raise comments, because otherwise I'm just going through and interpreting the picture. One starting point would be, what did we know before COVID? Where was the market going then? Where were economies heading? Where was your job security? And so forth. Economists would look at leading indicators for that. And one of the leading indicators from the financial markets is just interest rates, without going into exactly what the chart means, interpreting the axes. In plain English, what this chart says is that generally, long-term interest rates are higher than short-term interest rates, right? If I want to borrow money for 5 years, it will cost me more than if I want to borrow money, for a week, or for a month or something. And that's the normal. Normally that's called the yield curve, is upward sloping. Now, when the yield curve inverts, and it only inverts occasionally, when short-term interest rates are greater than long-term interest rates, right? When people get afraid, or when liquidity dries up, then you pay anything for money for a month's time, and if the long-term rate is very, very low, then you have an inversion. And that's what this chart is showing. It shows the long-term interest rate is decreasing, short-term interest rate is increasing, and if I just subtract one from the other, it shows down on the right, every time we cross where short-term interest rates are greater than long-term interest rates, there's a recession. And this picture plays out, let me hide this picture is not just now, it's a long-term picture, right? It shows as a predictor, as a leading predictor. It shows that, okay, here's where the last recessions were. Here's where we're at today. You tell me what's coming next.
And this change in interest rates was occurring before the COVID-19 outbreak.
Oh, yes, it's been going on for, you see here, it's been going on about, right in 15, 16.
Yeah.
And part of that is just general, well, we're getting a bit off topic, but if the government wants to stimulate the economy, one of the things that they can do is to pump in money. Interest rates go down, but if businesses don't have investment opportunities, they don't want it. They don't take the money.
Right.
And that's been going on for some time.
Right.
Right. So if I look at the next one, this is sort of financial markets, which tie together consumers, banks, and. If I look at real production, one of the leading indicators is what's happening to heavy truck sales. Again, these are common leading indicators that people look at. And the idea here is heavy truck sales are a proxy for how the economy is doing, the real economy, building things, building roads, big capital expenditures. When the producers, the construction companies, trucking companies, and so forth, go down, when their expectations of the future are that the future will be less than today, then they back up on their orders. Then I don't need to order as many trucks as I had before. And you see here also, the recessions are in color. Whenever truck sales go down, it tends to show that there'll be a recession afterwards. And this is where we're at now, right? And in all of the pictures, what you see now, it was sort of bouncing around, before, and then COVID-19 hits. This is one where, if we were just in here, we weren't sure. This could be a misleading one. But now there's this strict fall, where the market is saying, we're not going to get out of this fast. So that sort of is leading into COVID. So we've looked at financial markets in terms of borrowing money. We've looked at with the chart before, sort of real production with heavy truck production as a proxy for what's going on. What about the stock market? Right, to get back to your original comment, the stock market is one way to summarize what everybody is thinking will happen related to companies that they can invest in. And this chart I think is pretty interesting because in the news people are looking at different crises. They look at the 2000s recession, then they look at the 2008 recession that it's being compared to, and then there's the current COVID. Now, what happens to the stock price with each one of those? Well, of course, the direction is easy to predict. Stock prices will go down.
Right.
But what you see with the charts, to the right here, it takes a while. There's buyers and sellers, and it's a sort of a gradual fall, and you see how many days it takes to get down to the low of 57%, 49%. With COVID, what has happened is that the markets, have almost dried up. There's no buyers, there's no buyer, and you see that in so many of the markets, so that even here, after a few days, relatively, it's already down 29%. So this is the one that sort of ties together information at the broadest level for me. So if the analysis so far is okay, where are we going? The markets have pointed the way. The question, if you are an investor, is has the market as a whole overshot the mark? Are there investment opportunities for buying back, buying at a low price when the market comes back? That. So the first step is, well, how long can this go, and how bad can it get? Well, there the analysis sort of starts from point zero, which is China, and then it's moved over to the next major trading bloc, which is Europe, and then it's moved to the U.S., which is 4 to 6 weeks behind Europe, with the development. So if the ground level zero is the measure, then this is what happened in China. This is a measure of real manufacturing, right? The core of the economy, the generator of jobs. The developed economies, the service industry is the biggest, so in terms of employment, and so forth, but it needs a foundation. So when the foundation, falls off the cliff, then everything after that suffers. And this is this picture is what I think that people are worried about, rightly, for what it will look like in Europe and what it will look like in the States. One of the effects, so this lecture changes, discussion changes week by week. One of the things that I personally am looking for is how will things change later with the global economy? And one of the predictions that I am kind of buying into is that globalization will be not stopped, but different. Producers will look much closer at supply chain risk than they have up until now. It was never assumed that this could happen. So, which, we see the general trends in the economy are down. We see then what is the effect on one of the major markets, and was the core of this discussion. So what's going on in the oil market? I just sort of expanded on that a little bit. But what you see in the oil market picks up also with the picture that we've seen previously. This is a change chart. It doesn't have the absolute worldwide production of oil consumption, which is something above 100 million barrels a day. This is a change chart. How much has oil demand gone down since the beginning of this year? Right? We know that it's going down because people can't fly, people aren't driving around, the factories are working at a much slower rate. So we know that. How much has it gone down? And that's what this shows, right? If I just pick out a few of the points around in here, where we're at now, oil is down 7 million barrels a day.
Right.
This is worldwide. But if I price that at the prices of $60 a barrel, which is about where it was trading, roughly, that's $420 million a day. That is not going to oil producers. Where is the demand dropping? And that's where the picture also is kind of good. It just sort of confirms what we know already. The big drop here was because of China, right? And that was the first one hit. The big drop here, is OECD, which is where we're at now, flowing through Europe, and it also is predicting kind of this chart. Goldman Sachs is predicting that somewhere in here it should start to come back, but that's where nobody knows.
Yeah, I mean, to my mind, not knowing much about any of this, that seems like an awfully optimistic prediction at this point.
This is now old is something that's 2-3 weeks.
Right. Good point.
There's one quotation that I like is, if you have to predict, predict frequently, so you can keep changing.
Yeah.
Okay, so that's this chart. Why the oil price going down?
Fascinating.
But in parallel to that is our other effects. Is the oil price going down just because of COVID-19? Let me throw in one more thing before I get there.
Okay.
what's going on with oil prices, and what's the relationship to the US dollar, right? So there's really 3 points I wanted to kind of tie together so that they're not just disjoint statistics, but what's the story going on behind each of the, behind each one of those.
Mm-hmm.
So the story so far is that oil prices are going down or have gone down. And when I put it on a chart like this, an easier to read one, you see how dramatic that is for the oil producers. They're short a lot of money.
Mm-hmm.
What's going on with the dollar here? Or in our terms, what's going on with the forint, right? Is the forint so bad now because of Hungary, or are there other things going on? And the answer, because of the Hungarian situation or economy, and the answer is there are other things going on that dwarf the Hungarian economy, and the forint is just one of a whole basket, I would say, of all currencies that are not dollar. So what's going on? If you look at from I don't know, starting in 45, with the reorganization of the world currencies, so forth, the U.S. dollar has been the dominant currency around the world, and still accounts for some 70% of the world trade denominated in dollars. The euro is a piece, but the euro is still far away from the dollar. So the world, as a majority, is still dollar based, and it gets even worse, so to speak, depending on your point of view, or better, when you look at borrowing. The foreign countries borrow a lot in dollars. Foreign companies borrow a lot in dollars. So there's a dollar demand even outside of the States, that has to be met. So what happens when oil prices dive? The money generated from the sale of oil to, pick Venezuela, pick a lot of the oil producing countries, dives as well, but they need dollars to pay back for their country's debt, the company's debt, and what is reflected in the currency is there's a huge worldwide demand for dollars in any currency, right? So you see the dollar going up not just sort of as a flight to safety, but because of this over demand to service the debt. Right? So we're still kind of getting back to what else is going on with the oil. So COVID was a trigger, but the push for the steep dive in oil was actually something else. And I threw in this slide just in case there are questions or sort of responses, but everyone knows OPEC. OPEC is the driver that raised oil prices from $20 to $80, $90 in the 70s, and has been sort of the swing producer since then. Not everyone knows that there's this OPEC plus, which means that the OPEC, of course, but other countries that don't want to tie themselves exactly to OPEC, but also want to have the benefits of a oligopoly, I would say. And the biggest of those is Russia. Tends to move together with OPEC, participates in the OPEC meetings, but is not a formal member of OPEC. And you see, this is not a typo. In 2011, they each had production of around 10 million barrels a day. They tend to move together, but there is another player that developed in the States recently, a few years ago, really, called shale oil. And we won't get into that too much, but that's relevant here because shale oil turned the production of oil from a more controllable supply, controlled by, say, OPEC and OPEC plus, to something that is not controlled, is much harder to control. The numbers, just with this, and the organization of the industry is different, the cost structure is different, but what the effect of it has been is with this shale oil production, the U.S. has gone from a production level of around 6 million barrels a day to
Wow.
to 18 million
Mm-hmm.
in a few years with that. And that 18 million makes them makes the U.S. almost self-sufficient, in oil. So if the U.S. is the biggest consumer and the OPEC Plus would like to control prices to the biggest consumer, this is an issue, right? If there's another dominant producer already within the borders of the U.S., how can we control these? One of the things that happened then is OPEC, and particularly Russia, have never been too happy with the existence of the shale oil industry for that reason. The shale oil industry has a different cost structure, much higher cost of production, variable per barrel,
Mm-hmm.
than that. And so the idea is, okay, let's drive them out of business. Let's
Mm-hmm.
drive the shale oil out of business. We'll lower the costs. As soon as they start to lose lots of money, then that industry will shut down, and then we'll come back and produce with that.
Hmm.
That was what was going on here in part. The OPEC meeting I think that I have that on the next slide. The OPEC meeting about right in here.
Uh-huh.
Go with that. Sorry, where's the? Yes, here. Sorry, here's the OPEC meeting. The OPEC,
Mm-hmm.
the Saudi oil dispute.
Mm-hmm.
That's where there was a difference in strategy. The Saudis wanted to OPEC. Saudis are a placeholder for OPEC.
Right.
Wanted to reduce the supply and agree with everyone. Let's have supply cuts.
Mm-hmm.
That hurts a little bit, but if it works, then you can still sell close to the $60. You'll just sell less. Russia has a different strategy and walked out of the meeting. Then they both agreed to disagree.
Mm-hmm.
And then Saudi said, if you want to, I'm just sort of personalizing it. If you want it like that, then they'll turn on the pumps, and they did.
Wow.
So that's what's been happening here as well. The prices have dived because all of the storage facilities and the ships everywhere where you can put oil are filled. There's no place to put oil right now.
Mm.
So that's the pictures for me are interesting because it starts to, when I put the stories together in my own mind, and I start to see the interconnections of what's going on in the market rather than not just COVID-19, but other things happening in parallel, where it's not all related to COVID-19.
Right, and amidst all this, amidst the OPEC and OPEC Plus reaction to the shale industry, the shale oil industry, and amidst this dispute, this disagreement between Russia and OPEC, personalized by Saudi Arabia, we now have global demand, dropping very, very sharply. So what do you think that does for, how do the oil producing countries react to this massive drop in demand?
This is where they're a price taker, the way I see it. They can't really stimulate demand on their side. OPEC itself has no population. I mean, the Middle East OPEC. Russia's population is minor compared to even just to EU, so they can't stimulate demand on their side, and they don't have it, or they wouldn't be spending money to stimulate demand in the big consuming countries, like the US.
Mm-hmm.
So they're mostly watching rather than taking actions. The governments around the world, and again I refer to previous recordings that you had, they are concerned. This one is close to home. What can the government do to stimulate some demand? Because I don't know, say 65% of the economy depends on consumer confidence, depends on consumers going out and buying things. If that dries up, then it's sort of a spiral downward or a vicious circle. And that I have in the last chart of what do the markets say right now, about where is consumer confidence going. But to underline that, maybe I saw another interview. There's a big investor called Ray DeLeo, who's on the order of Soros, maybe not quite that famous, but manages billions and billions in his investment fund. And of the four things that he mentioned for what are we in now, I won't go through that lecture. He said, in his opinion, also the one that will drive how quickly we come out of this and in what form we come out of this will be, he termed it, how do we treat each other? How do people react to their neighbors, so to speak? And he sort of summarized that under politics. What will the politicians do, or what will politics? And I don't mean that in any bad sense. It's somebody has to organize the economies. Will they put up the borders, figuratively, and just focus on what's good for us, or will they view that we, the world, are in this collectively, and spread that additional demand, not just within the borders of, say, the U.S. or within the borders of the EU, but broader. And that's a big question mark. That's a big question mark of what will happen. But that will, in part, probably in a big part, determine the consumer demand worldwide, because it's not just the U.S. and not just the EU. Yeah.
Well, let's can we?
Let's go on. Yeah, let's go on.
Let's look at consumer demand, because I think this is where you're headed, really.
Okay. We could skip to that part. Yeah. If I would. Let me just go to that, because we're almost.
Forgive me, consumer confidence. Yeah. Wow.
Yeah. So consumer demand, the basis for that is, or this one was charted, will there be a recession? And I played off of that from the previous discussion, and now everything I see in the last week or two is recession is for sure.
Yeah.
Now it's just a question, technically, of whether it will be a depression or not. And I say technically because the word depression has a lot of additional connotations to it that are not part of economics. Economics just defines it in terms of how long how far down does production go and how long does it last. But the driver of that demand, it can come from several sources. The government, companies, but the underlying driver is consumer confidence, and that's why this chart is interesting. What is happening now? So you see also along the bottom, marked when there were recessions, and marked when this is a chart that has both equity and bond markets as well as consumer confidence. Shows what happens when there's a crossing point, and this one is useful because it's has a little bit more of a basis than just I don't want to say it, newspaper reporters or people. I feel that people aren't confident, or I feel that people are pessimistic. Well, one thing that is a positive development in economics, starting even before in the 50s. And I won't go into the history, but is let's go around and ask people, and let's track their responses. Let's ask them at regular intervals, track their responses, put that into an index, a broad-based index, and call that a measure of confidence. And that's what this is, right there. That's a conference board consumer confidence index. So it has a history, right? And another leading indicator then is, when does it cross this crossing point here? And I tried to blow that up here a little bit. When is there a cross in that between what's going on in the financial markets? And we hit that now.
Yeah, I see.
Yeah, and that's what this chart shows. So if I was asked, what are the markets predicting? The markets are predicting a recession. If I was asked, how long will it last? That's where, don't know, of course, but that's where the pointing point, the response would be, well, let's wait and see, or we have to, let's wait and see what the political responses will be at the national level. And then as we start to expand that into the bigger groupings, like the EU and so forth.
Yeah.
So that's kind of my slides.
Okay.
Of the picture.
Can we return to the full screen, and then I have a final question for you. So we're in a situation which, in its way, can be compared to the Great Depression of the 1930s. At least in the strict sense that we could very well be in for 4 quarters of recession, and therefore, I guess what the economists would define as a depression. And I'm hardly a historian of that period, but when I think about the reactions of national economies to the Great Depression, you think about Keynesian solutions to stimulating demand. You think about collective solutions at a national level in the United States, in Great Britain, in France, and other countries as well. And those were of fundamental importance to the development of those various societies. And I wonder, right now, of course, nobody's able to make any predictions about what will happen in the coming years. But what are some of the questions that you're asking? In other words, you were just speaking about this economist or this investor rather, you had recently listened to, listening to him and then thinking about the problems that you just set before us. What are some of the questions you'll be asking, or some of the observations you'll be trying to make in the coming year, as far as the global economy is concerned, and as far as, like you said, the reaction of politicians, not in the strict ideological sense, but in the policy-making sense. Did you follow me?
Oh, I follow exactly.
Yeah. I mean, I hope I'm reasonably clear.
I wish I could take credit for all of the original thinking that I'm reading and hearing about. So I'll repeat what I have read, heard, and give references if anybody wants to follow up more. But the analysis that I believe in right now, or that carries weight for me, is that the economies go through 2 kinds of credit cycles. There's a short-term credit cycle that lasts about 8 to 10 years, and then there's a downturn, and that fits with history as well. That fits with the 2008 and so forth. There's a longer-term credit cycle where the financial, and without going into everything that's happening and why it turns into that runs from 70 to 80 years, and that means the last one started about 1945. And my one little sort of takeaway of thought for another discussion, so somebody else's turn, is both of those are sort of at a point now. The short-term credit cycle is hitting, the long-term credit cycle is hitting, and what happens at a point like that, and again, without going into who's writing and so forth, what happens at a point like that is that there's a change in the world, I don't know, sort of currency order. It's not a question of that there's demand out there. It's not a question that there's enough wealth in the world, to cover the 6 billion. What you have is an accounting. You have currency, which is a way of measuring how much do I have and how much do people owe me. And what the one prediction is, there will be a change now. There was a major change after World War II, where the world order was changed. And the prediction now to watch is how will that change now? How will this wealth, the prediction is there will be a wealth redistribution. And we see that already at the local level, right? A redistribution from banks to borrowers. And that's just the first of many coming. That redistribution will be guided by politicians. And again, I don't mean that in any derogatory sense. The actions have to be taken, and that will be the thing to watch now. Of how will the new world currency order, new world payment order, how will things play out with redistributing, within a country, within a union, and across the world play out. Those are big pictures that I like to watch, and I'm curious about also how this will play out.
I see. It's certainly fascinating, and I think that the visual illustrations you provided us help considerably in having some reasonable concept for understanding what's happening right now. So thank you very, very much, Charles, for your time today. And let's revisit this topic. It's changing constantly, and therefore a new, fresh discussion is, for better and for worse, probably possible often. And,
okay,
oh, please, go ahead.
Yeah, thank you to McDaniel for putting the platform together. I think it's a useful contribution to keeping our social network up.
Yeah, well, that's the least of what we can do here. So, so thanks once again, and let's do it again.
Okay, thank you.